Hi, and welcome to the Crescent Private Wealth third quarter 2025 market report. My name is Omar Bassal, Chief Investment Officer. So today we'll be covering the following asset classes: what happened, why did they move, and what we can expect going forward. We'll start off by looking at the US dollar. We'll talk about US interest rates. We'll talk about US equities. We'll look at global equities, gold, and finally Bitcoin. So what's important to note about the US dollar is that this year has been a pretty remarkable year. The dollar has declined significantly, about 10% in the first half of the year. And this is the worst performance for the dollar since 1973. The dollar is sitting at a 3-year low, and the weakness reflects a lot of concern from international investors regarding US economic leadership, US policy. This is partly reflective of the tariffs, but also partly reflective of other actions the U.S. has taken. And for example, Canada's targeting of being a 51st state has really affected the way Canadians look at investment in the U.S. Another factor has been the worsening fiscal outlook. So the U.S. has been spending significant amounts of money in excess of revenues, and that money needs to be borrowed, and some of the borrowing occurs from U.S., from local investors, but some of it occurs international. So anytime you have a excess spending, increase in debt levels, you will tend to have international investors start to become somewhat concerned about, will they be paid back in printed dollars that might be worth less. So all of it put together has been that the dollar has been weakening relative to other major currencies such as the euro, such as the yen. And we don't necessarily, there's not really good reasons to expect this trend to reverse. We recently saw Moody's downgrade the US credit rating, and one of the factors what they cited was the national debt. So debt levels in the US, at least with respect to the federal government, is about 130% of GDP, which is extremely high. And so what happens is that the higher your debt, the more interest payments you'll make. The more interest payments you make, the less money you have for other items. So to give you some figures, the US will spend about $1 trillion on interest alone in this current fiscal year. That is comparable to what it spends on military. It's about 13% of the budget. So it gives you some sense that this is a significant burden, and unfortunately, there's not a current outlook that that's going to be declining. In other words, spending levels are still in excess of revenues, so you should expect that there will be more interest payments going forward. Interest will take a bigger chunk of the budget. Now, these two charts in front of you highlight what I was sharing with you. So let's start with the chart on the left. It's showing you interest payments, net interest payments, as a percentage of the GDP. So what you can see here, the solid line is showing you that level has reached about 3% of GDP. And the forecast is for it to reach maybe 7% by 2040. Again, that's just a forecast. More than likely, before that happened, there would be some kind of dislocation, which would force the government to not spend so much. And that dislocation could come as a result of weakening dollars or much higher interest rates. Effectively, that would force the government to do a course correction. But in any case, if you look at the history, this goes back to 1800, you can see that we're basically sitting at record levels of interest payments relative to GDP. So as a side note, the 13% is relative to the budget, which is how much the government has revenues and spending, federal government, but this is showing you relative to GDP. If we look at the chart on the right, you can see that the level of debt at the federal government is about 120, 130%, again, forecasted to skyrocket. And this, again, is something that is probably not sustainable. And if you look at history back to 1800, we're looking at pretty much peak levels or levels that were not seen since World War II. Now, what's important to note is that it's understandable, except even expected, that in times of crises or wars, that you're going to have an increase in spending or debt, but we are not really in a major war time, so to speak. In fact, we're not in a recession, and yet the U.S. debt levels are at record levels. So in a recession, what you typically see is the debt to increase even more, and there's good reason to believe that we are nearing a recession. This is a chart of the US dollar. This is about 10 years. And again, just to give you some kind of sense here, again, this is the dollar relative to other currencies. And you can see that it's sitting at a 3-year low and moving lower. So this is a concern. It's a concern because it will affect, for example, if you decide to travel outside the US, you'll notice that everything's more expensive unless you visit a country that uses the U.S. dollar as their currency, or if you visit a country that has even a weaker currency, which is unlikely. If you visit Europe, if you visit most of Asia, you'll see a big hit. So that clearly is one negative impact. But the other negative impact is that the prices of imports will be increasing. So the weaker dollar will lead to higher inflation. Let's talk about interest rates, and we're going to talk about short-term rates, long-term rates. So let's start with short-term rates. The short-term rates are heavily affected by Federal Reserve, the central bank in the US. Short-term rates affect things like credit cards, credit card debt, auto debt, short-term bank deposits. There's long-term rates, which are set by the market, not by the Federal Reserve. And long-term rates affect things like home mortgages, long-term corporate borrowing. So when it comes to short-term interest rates, so you're looking at a 2-year government bond yield, you can see here that the federal funds rate, that's the rate that the Federal Reserve sets, is around 4.3%, and they make a range. And you can see that short-term rates are likely to decline. And the reason I say that is that the Fed is forecasting they will be cutting rates in the next couple of months. Probably not at the next couple of meetings because they're wanting to see the impact of tariffs, but they have forecasted about 50 basis points of cuts by the end of the year. So you should expect short-term rates to fall. Long-term rates, it's not set by the Federal Reserve. It's affected by supply and demand of government debt. And when it comes to long-term rates, there are good reasons to believe that they will be increasing, unlike short-term rates. So here's a headline from that came out last month regarding Canada selling the most treasuries on record, coming after the 51st state talks that was coming out from the White House. So effectively, Canada, well, we can't say for sure that this is the reasoning, but we can definitely, it's a hypothesis that Canada was unhappy with all this talk, and they've been deciding to reduce their holdings of U.S. debt. I think that makes sense, and given that it's a record decline in 1 month, it would seem to support that. Hong Kong has indicated, Hong Kong pension plans have indicated that they will cut their exposure to U.S. debt if the U.S. loses its AAA credit rating, AAA score. Now, again, all of these are indicative of international investors becoming nervous about holding U.S. assets, and therefore you should expect long-term rates to be affected by that, because if they decide to reduce their exposure to U.S. assets, and one of the biggest investments is typically debt, then you would expect interest rates to go up. Here is a chart of the U.S. government bond yield for the 10-year. So this is a typical measure for a 10-year for long-term government bond yield, and you can see how it's risen substantially from 2020. Less than 1% now, roughly 4.5%. Again, the higher this is, the worse it will be for the health of the U.S. government, the federal government, because as they borrow more money, they pay this level of interest, and therefore the interest payments become a larger and larger share of revenues, which means that you have to borrow more and you have to spend less on what you might want to do. And if you don't do that, sometimes the market can force it. And what I mean by that is that if the market becomes nervous about holding U.S. debt and sells it, that will shoot up interest rates very high and make it somewhat difficult to continue spending in that high spending way. So That's not happened yet. We've seen it happen in many other countries. The US has kind of been able to get a pass because it's the largest economy in the world, and so many people have invested historically in the U.S. But I think it would be wrong to assume that can go on forever. International investors are becoming much more wary of holding U.S. assets. Let's look at U.S. equities. So in the second quarter, U.S. stocks rose about 11%. Tech stocks led the rally, while value stocks lagged. So value companies typically low valuation multiples, whereas tech stocks typically have much higher valuation multiples, but also typically higher growth rates. And what we saw is that the U.S. stocks initially declined significantly in April. They had a recovery as there was a pause in the highest tariff rates. Now, what you should know about U.S. stocks is that they are incredibly expensive historically. So this is a chart showing you the one of the valuation measures of the S&P 500. It's expected earnings over the next 12 months, the current price divided by the expected earnings over the next 12 months. And I think it's important to notice how high it is, despite the fact that growth rates are slowing in the U.S. Despite the fact that a recession is, we can't say for sure it's a guarantee, but I would say very, very likely. And I'll show you some data around that. But essentially, if typically in a recession, this valuation measure will typically fall to 12, 13 times. You can see here historically, every gray shaded area in this chart is a recession. So you can see that in the recession of 2020, it fell to 13. And in the recession of 2008-9, it fell to 9 times. In the recession of 2002, it was around 13 times. We're sitting at 21.5, 22. So, if a recession does occur in the next 12 months, you would expect potentially that multiple to go down, which would lead to underperformance of U.S. stocks. So why do I say that a recession is likely? I don't really put much weight into forecast. I think it's very anyone can have an opinion about anything, but I like to look at data. And so this is a chart showing you. So let me explain how this works. The blue vertical bars are recessions. I'm sorry, I apologize. The red vertical bars are recessions. The blue vertical bars are indicative of when certain criteria are met in this model. So what does the model do? It has 5 measures, and for example, the first measure is that it looks for when the S&P 500 is below its value sits from 6 months ago. And the reason that we look at that, or the reason this particular model looks at that, is because the market is a forecaster of recession. So when the market's falling, it can be indicative of an upcoming recession. So you have 5 criteria that need to be met. The first one being the S&P needs to be lower than it was 6 months ago. The second one being that a specific index of purchasing managers, which is useful for measuring economic activity, needs to be below 50, which is indicative that the economy is contracting. Another measure is looking at the yield curve, which is the spread between interest rates, the 10-year and the 3-month, which can be another indicative measure of a recession. Whenever you have what's called inversion, where the short-term rates go above the longer-term rates. You have another measure here that the credit spreads need to be widened. What that basically means is that when investors are very nervous about getting paid back, then they will typically demand a premium over corporate debt. And that premium is we look at as credit spreads. And so anytime these credit spreads widen over a period, it can be indicative of stress. And the last measure here is simply slowing job growth, which we have seen. So what I'm sharing with you here is that historically this model has worked pretty well at forecasting recessions, and it recently gave a signal, meaning that those 5 criteria were met. Again, not guaranteed a recession will occur, but certainly more likely than not, I think is a way to put it. So if a recession occurs in the U.S., you should expect valuations to come down. Again, hard to know when, but I think really the next 12 months, it would be reasonable to assume the tariffs are another headwind for the U.S. economy. If we talk about global equities, in the second quarter, they outperformed U.S. equities, which was also the case in the first quarter. One of the factors has been the U.S. dollar. So as the U.S. dollar weakens, it benefits global equities because they're priced typically in non-U.S. dollars. And so you might have, for example, the European index go up 10% in euro terms, but then if the dollar declined by 10%, it's actually up 20% in dollar terms. So the weaker dollar is a nice tailwind for global equities. Another thing to keep in mind is that unlike the US, international markets don't have to worry about tariffs with everyone in the world, right? So, if you're Taiwan, you're thinking about tariffs with the US, but everyone else, you pretty much have normal trading relationships. The same goes for Korea, Japan, the UK, Germany, France, etc. So the point is that the tariff, which is a tax, is something that the U.S. is facing with everyone, whereas other countries are only facing it with really one country. So even though it's a large, one of the largest trading partners globally, the largest economy globally, it does mean that these other countries will have less problems from the tariffs than the U.S. will. And again, as I mentioned to you, international investors have been reducing their exposure to the U.S., both stocks and fixed income, and that has also been a factor of boosting the returns of international equities. One thing I will mention, though, that doesn't necessarily mean that all international equities are great. So, within the international equity world, you have what's called developed markets, such as Germany, Japan, the UK, Australia. Those are the developed markets. Then you have the other markets, which are called emerging markets, such as India, China, South Africa. And I would say that the outlook for the emerging markets is less positive. So the chart you're looking at right now is the green line is the actual performance of emerging markets in US dollars, whereas the bluish line or solid line, let's say, is an indicator for basically the health of manufacturing globally. So emerging markets are very sensitive to the global manufacturing cycle, and you can see here that the new orders component of this international indicator has turned down recently, and historically there's a very tight relationship between this indicator and emerging market stock prices, and sure enough, you should expect emerging markets to follow suit. They will probably underperform, Japanese or the developed markets, Japan, Germany, France, UK, etc. Let's talk briefly about gold. So last month, there was a survey released by the World Gold Council. They spoke with 73 central banks around the world, and they asked them about their intentions regarding gold and accumulation and so forth. So the respondents overwhelmingly indicated that they expected global central banks to increase their exposure to gold. So when it comes to gold, one of the major demand drivers is central banks. Another demand driver is like other investors. And then you have jewelry demand, but that's typically not very volatile. Another indication from the survey was that a record 43% of respondents believe that their own gold exposure reserves would be increasing. So again, that's indicative that central banks around the world are probably selling US dollar assets and buying gold. None of the central banks in the survey indicated that they would be reducing their exposure to gold. Finally, a majority of respondents see moderate or significantly lower US dollar holdings within global reserves. So majority of the central banks said, hey, listen, we don't expect to increase our exposure to US assets. We're actually the reverse. We expect there will be a reduction in U.S. Asset holdings across central banks. So this is indicative. These are all positives for gold prices going forward. And so I just want to quickly show you this interesting chart from the Financial Times regarding the central bank activity around gold. So remember, central banks buying and selling gold is a major demand driver for gold demand. And so you can see here that in 1960s, there was significant accumulation by central banks of gold. And that makes sense because in that period, the currencies were fixed to gold. So there was a fixed exchange rate between like the dollar and gold. And then you can see that Nixon broke that relationship in 71. And then basically for the next 40 years, there was central banks selling gold. So they weren't really, once there was no requirement to fix exchange currencies to gold, or to the dollar, there was this reduction in U.S. In central banks' holdings of gold. And then you can see that what happened in the GFC, the global financial crisis, central banks said, hey, some of these assets that we thought were safe are not. And therefore, you can see a resumption in accumulation of gold. And then in 2022, when Russia invades Ukraine and you have the U.S. decide to freeze Russian dollar assets, other central banks said, hey, if the U.S. can freeze Russia's assets, they can freeze our assets. So it simply accelerated the demand for gold by central banks. So again, gold is well supported. Doesn't mean that it's going to go up next month, but there is a long-term story here about why you should expect gold prices to continue higher. Some people tell me, hey, that's interesting, but gold seems so expensive today. Look at how high it is, $3,400 an ounce. And my response to that would be, it doesn't look so expensive if you simply compare it to stocks. So this is a chart of gold to the S&P 500 index. So you can see here that in 2011, that ratio reached a peak about when gold prices reached around $2,000 an ounce. But today it's much, much lower. So at least relative to stocks, gold is very cheap relative to U.S. stocks. And so finally, I want to talk about Bitcoin. So Bitcoin is, sometimes it's called digital gold. But I think what's relevant here, again, it's a supply-demand issue. The supply of Bitcoin is fixed. It can never exceed 21 million Bitcoin. It's around 19 plus million right now. It increases every year. And what you should know is that a lot of companies are now simply being formed to buy Bitcoin. That's literally what their business plan is. Sounds strange, I know, but that's the current reality. At some point, that won't make economic sense, but that's not today. And so here's an example of some companies that are publicly traded that actually own Bitcoin. Strategy owns, you can see here about 600,000 Bitcoin, and another company called Mara Holdings owns around 50,000 Bitcoin. And this is, there are many companies like them, and there are new companies that are being formed literally, I think, on a weekly basis. Again, they're being funded by billions of dollars to buy Bitcoin because it's been so profitable. And so just to give you an idea here, in this year alone, we've seen Strategy. This is the largest publicly traded company that owns Bitcoin. They've literally purchased about 150,000 Bitcoin, and the amount of increase in supply of Bitcoin has been 78,000. So what that means is that they have purchased all the supply that was increased this year and more. And the thing about Strategy is that once they purchase Bitcoin, they don't sell. So effectively, the supply of Bitcoin is shrinking as a result of their purchases, but it's also as a result of other companies' purchases. And therefore, you have this major tailwind behind Bitcoin, which, again, anyone who tells you a price, I would just say to you, take that with a grain of salt. But certainly, I think that as long as what this dynamic is happening of companies acquiring Bitcoin, I don't want to say the sky's the limit, but it can significantly increase from current levels, no doubt. In other words, you shouldn't think of it as simply the price. It's the reality is that there's companies buying it every day, and they are continuing to buy it. When and if that changes, our opinion can change. But since that's the reality today, I would tell you, hey, Bitcoin looks extremely attractive. Thank you for listening to our presentation, and look forward to the next quarterly update, but we'll also provide you monthly updates going forward.